Right. Good morning once again. We are refreshing what we have done in the last class. So we looked at what business finance is. We looked at accounting versus finance and why we have to study corporate finance or business finance as we would like to call it. And then what are the functions of a financial manager? We looked at the functions of the two key functions, the investment function and the financing function. We also call them as the key decisions, key financial decisions. So this I would like to go through once again. Raising funds is one of the functions. The finance manager would raise funds, invest it through raising funds is through stocks or debt securities, which we call it as equity or debt. Through that, the finance manager would raise funds and then invest where? Invest in plant or equipment or in different projects. Once invested, there will be some cash flow from the operations. That cash flow will be either reinvested or will be given as dividend to the shareholders. And all the interest, if it is taken as a loan, if the funds are raised through loan, the interest will be paid. When I said reinvested, usually what happens is part of it is reinvested and part of it is retained as earnings and part of it will be given back to the shareholders as dividends, and if there are loans, part of it is given as interest payments. So this is what normally happens, right? This is what we discussed in the last class and we call them as major financial decisions. The two key major financial decisions, investment decision and financing decision. We have not included this part, the dividends part. Dividends decision is also one of the decisions, but we are not discussing about that. We are discussing about the two major financial decisions, which is the investment decision and financing decision. Again, the same thing is shown in a different way. The finance manager, when he is deciding on the investment, he has to think about or answer a few questions. How much to invest? What assets projects to invest in? These are some of the questions that he has to answer. So this part, where you answer these questions, where you evaluate the projects and see where to invest, how much to invest, that part will be discussed in a topic called capital budgeting. And then financing decision, part of financing decision, source of funds. What should be the source of funds? It should be the funds should be raised through debt by taking loans or through equity by issuing shares. How should the money be raised for the projects that you want to invest in? So this part will be discussed in a topic called capital structure, right? And then there is also working capital management decision. This also we will be covering in this course, right? But two key decisions are investment and financing decision. When we are discussing these two, we will be going very slowly. There is a question from Ashwini. Ma'am, what is this flow shows? Financial market, financial manager, operations. So basically, financial manager is, I'll go back one slide. See, this is the financial manager. And you see here, operation, you see here, financial markets. So meaning, when you're raising funds through financial markets, right? And when you're, sorry. And when you are investing in the operations. Just one slide before. That is what we discussed. When we are saying operations, we are investing in plant, equipment, or projects. That's why this operations is here. And financial markets. Financial markets are people with surplus funds. This we will be discussing. In one of the slides, we'll discuss what surplus funds are, who the investors are. Cursor is not visible. Alright, I'll be starting annotations. That will be easier then. If cursor is not visible. So, when we're talking about the financial manager, he's got operations. Operations meaning the investments that he wants to make. He would like to make the investment in plant, equipment, or projects, right? And the funds that are raised through financial markets. We'll discuss what financial markets is. We'll look at the definition as well, where the finance manager raises the funds through stocks or debt securities, meaning through equity or debt, right? So that's why there's financial managers markets here and operations here. This operations links to the investment decision. Financial markets through which the funds are raised is linked to the financing decision, right? Now if you look at this slide, it must be clear to you. Is this clear, Ashwini? And Devendra, is the cursor clear now? Can you see the annotations? When I'm marking something, are you able to see? So investment decision, that's why it's linked to the operations are linked to investment decision, because that is where you're going to invest. Financial markets are the markets from where you raise the funds, so that is linked to the financing decision. Is that clear now? So this part is what it is shown in this box here. This box is pertaining to the financial markets. What should be the sources of funds? Should the money be raised through debt or equity? Right? This we study in the topic called capital structure. And how much to invest? What assets or projects to invest in? That will be studied in a topic called capital budgeting. Right? We also will be looking at working capital management decision. But when we talk about two key decisions, we will be generally referring to investment decision and financing decision. In working capital, what we'll be looking at? How best to manage the cash flows from day-to-day operations. That is what we will be looking at. We will also look at a simulation to see how it can be done. Right? And there's one more decision, like I said, called dividend decision, which we will not be discussing in detail. But please be aware, the other decision a financial manager makes is dividend decision. How much to give, how much to retain, what is given to the shareholders, that part. When we come to stocks, we will discuss briefly about it. And then we also discussed in the last class about the critical factors in financial decision making. The three critical factors is cash flow analysis, cash flow timing, and cash flow risk. We discussed in detail what timing of the cash flow means. We discussed how there is a time value associated to money. Money has time value, right? If the time changes, the money value also changes. We will be discussing more in detail today about that. And then risk, we discussed what risk is. It's a variability. Again, we discussed in length to understand what the variability of cash flow stream means. Meaning, if you're expecting something, any deviation from that is variability, and that is risk here. So any deviation from expectation, as we call it as mean, is nothing but standard. We actually measure that using standard deviation, right? So risk also is measured using standard deviation because it is the variability of a cash flow stream. Is that clear? So this part again we'll be discussing risk management again as we go further. Risk and returns as the topic is called. So here we're only just trying to refresh our memory on what we discussed in the last class. And then the goal of corporate financial management. We discussed about what the goal should be. What the goal should be for a corporation. Is it maximizing revenues? Is it maximizing costs? Maximizing profits? Or maximizing shareholders' wealth? Right? We discussed all these four options, understood what they are, and then we said maximizing shareholder wealth is what we will be looking at. That is the goal of corporate financial management. So as a financial manager, your goal, your objective is to maximize the shareholders' wealth. This is what we discussed in the last class. Do you have any questions from this, what we discussed in the last class? Today, do you have any questions? Ashwini? Santosh? Anil? Anand? Balaji? Akhilesh? Any questions from last class? Alright, so we are continuing today with the next part. So the ticked ones that you see are the ones that we discussed in the last class, and today we will be discussing about the remaining. Of course, this is just one part of it, and then we will also move on to time value of money. That is the next concept. So we have not finished the introduction in the last class, so this part we will be discussing, the part that we have not finished. So we said the corporate objective should be to maximize the shareholders' wealth. So again, we're just going through that part. We said maximizing profit is wrong. It should be maximizing the market value of a company. In other words, maximizing the shareholders' wealth. Right? So when you say wealth, this means basically maximizing shareholders' wealth means using scarce resources, land, labor, capital, etc., more efficient in a more efficient manner. So we can maximize the wealth of the shareholders. And now, in this part of the introduction, we will be discussing about certain terms, like I said, what these terms mean to us. You may feel a little bit of disconnect here and there because we are just bringing in some terms. You may not see a logical link of why we are discussing about it in some places. But as we go further, when this term comes, we'll reiterate that and we'll see what it means again, right? So in this part of the introduction, you may feel a few more terms being introduced and you may see a little bit of a disconnect. But bear with me, as we go further, it will get clearer. So corporate financial decisions, we discuss financing decision and investment decision. So when we are saying maximizing wealth, basically what we are doing is we are making decisions, these two basically, financing and investment decision, that increase the wealth of its owners. And when we say owners, the shareholders are part owners, right? So maximizing the wealth of shareholders meaning you are maximizing or increasing the wealth of its owners. So owner wealth, how do you measure? It's measured by the market capitalization of securities. Now what is this term? Market capitalization. Market capitalization, as it is also called as market cap. Owner wealth is measured by the company's market cap. Market capitalization of securities. What is market cap? Market cap is the number of shares that the company has multiplied by its share price. The company has 10 shares, let's say, I'm just giving you an example, and each share is 10 rupees each. So the market cap of the company is 10 times 10, 100. Right? So when we are saying wealth, what we are trying to look at is, when we are quantifying, when you are trying to measure it, this is what we are measuring. Market capitalization, the company's value meaning market capitalization of its securities. Right? Balaji has a question. Yeah, that is the book, Balaji. Balaji is asking me, it's the first book, Principles of Corporate Finance by Myers, Allen and Mohanty, published by McGraw-Hill Publications. That's true, Santosh. Santosh is saying the number of shares keep varying, but the number of shares issued will be the same, right? So the market cap keeps changing. So at the end of every quarter, at the end of every half yearly or whenever the company wants to calculate, it will calculate. At any given point of time, you can also calculate how much is the market cap. No, you cannot increase. You cannot increase the number of shares just like that. Kaderi says there are two ways of increasing the market cap: either increasing share value or increasing number of shares. Increasing number of shares is not a good thing. The share value gets diluted. If the company's value, let's say, is 100, and there are 10 shares, right? So it is 10 rupees per share. Now, if you increase it to 20, it does not mean that 20 times 10. It will be whatever this 100 divided by 20. Right? Let's say there are 100 rupees. 100 rupees is the market cap. There are 10 shares. So 100 divided by 10, each share is 10 rupees. It does not mean that if you are increasing that to 20 shares, it becomes 20 times 10. No, it becomes 100 divided by 20. So the value of the share decreases. Right? So that is not the right way of doing. That's right. Total number of the shares are the ones that are issued, registered in the beginning. So you cannot just keep increasing them. If you keep increasing them, the value gets diluted. We'll look at this question, Balaji. We'll come back. Let's not divert. We'll come back to it. I'll definitely address that. All right. So that's the market cap. Now, why should a company aim to maximize its market value? Generally, what we say is the standard economic model of economics. Basically, this is economics justification, as we call it. Standard economic model, SEM. According to that, individuals, us, are utility maximizers, meaning we want to derive satisfaction and happiness from whatever we do. Right? If I buy a chocolate, I get some satisfaction. If I eat a chocolate, I get a satisfaction. Right? So utility, that is the utility. That satisfaction is the utility. Now, utility is a function of consumption, meaning I'm eating it to derive that utility. Right? So individuals are utility or satisfaction maximizers. To get that satisfaction, I need to consume it. I need to eat that chocolate. Right? Consumption is a function of wealth. Now, how can I buy that chocolate? I need to have money to buy it. Right? So, if I want to eat it, I need to buy it. Consumption is a function of wealth. Utility maximizing individuals wish to maximize their wealth. And therefore, if I want to maximize the utility, I need to maximize my wealth. If I have the wealth, I can buy. If I can buy, I can eat. If I eat, I get the utility. Is this part clear? So this is according to the standard economic model of, or we can also call it as economic justification of why a company will aim to maximize its market value. Market value is basically the wealth maximization. Why do you need to maximize the wealth? So you get the utility. And we know that individuals hold part of their wealth in the form of shares in the company. Right? So part of their wealth is held as shares in the company. The market value of the company is represented by the share price multiplied by the number of shares on issue. You cannot just keep increasing. Whatever is issued, that number. Therefore, the greater the market value of the company's shares, the greater will be the company's market value. And the greater will be the wealth of its shareholders. So, if the wealth is, the greater the wealth, we know that greater the utility according to the standard economic model. Does this make sense? Any questions in this? Please go through the slide slowly and ask me if there are any questions. Rajmohan asked me if a company is not listed in market, is still market value is applicable for the company. Market value, you can say the value of a firm or value of a company, but in terms of shares, if there are no shares, you obviously cannot say market value because there's no shares to multiply it against, right? So what are we saying is a market value? Market value is a share price multiplied by the number of shares. But that does not say that the company does not have a value. Non-listed companies also will have a value based on their assets, based on their revenue, right? Santosh, which part you want me to repeat? Balaji says, is this a cycle? It's not like a cycle, but basically this is what we do as individuals. So that is the model that is given in economics is economic justification of what we do. We want to derive satisfaction out of the things that we do. In order to derive satisfaction, we have to consume. If you want to consume, we need money, right? That's why we maximize the wealth so we can get the utility. So we can consume, by which we can derive the utility. That is the model. So generally, this is what we do in the things that we do. Be it having a cup of tea or having a chocolate or even going for big things in life. Okay. Santosh says he wants me to repeat this part to the market value. So now this part, the standard economic model, we understood. Now how this links to the market value. So likewise, individuals. Now if we have money, we maximize our wealth, right? We maximize our wealth so we can derive utility. So if we maximize our wealth, we have money. This money has to be held in some form, and one of the forms is buying shares, investing in shares. So the market value of a company is represented by the share price. If you are investing in shares, right, the price at which you are buying those shares will determine the market value of a company, right? If the share price is 10 rupees per share, right? Likewise, all individuals, people who are having that extra wealth, surplus wealth, will invest in these companies, right? If you're talking about one particular company, the number of shares that are on issue and the price at which it is bought, you multiply to understand or get the market value of that particular company, right? So the link here is this wealth that we have maximized, that wealth will store or hold in some form or shape, and that one of the forms is investing in shares, right? Those shares will determine the price. If people are investing in shares, there is a lot of demand for shares, the price will go up and the price will determine, we will not talk about going up and down yet, but the price will determine the market value. Vikas says, share is an instrument to raise capital. How is it related to wealth? Share is an instrument to raise capital. True. It is related to wealth because if you want to invest, you need to have that wealth, right? So that is what we are saying here. Karam says, utility of individuals generates demand for wealth maximization. That's true. Utility of individuals generates demand for wealth maximization. You want to get the satisfaction for which you want money. So that is why you want to generate money or maximize the money. That is correct, Param. Right? So we'll move on. Now this is something, again, just out of the blue to understand what these terms are. We generally talk about corporate mission. While managers have to cater to all the stakeholders such as consumers, employees and suppliers, they need to pay particular attention to the owners of the corporation, that is the shareholders, right? So if managers fail to pursue shareholder wealth maximization, they will lose the support of the investors and lenders. If there is no wealth, if the company is not performing well, why would I like to keep my money in that company? I would like to pull out and put it in a company that increases the wealth. Right? If I invest 10 rupees today, if it becomes 15 tomorrow, I'll be happy. If I invest 10 and it's becoming 5, then I would not be happy. Right? So if the wealth is maximized, then there will be support from the shareholders. If the wealth is not maximized, then we lose the support. So the business may cease to exist and ultimately the managers will lose their job. This is just an understanding. Right? So what will be the corporate mission? The corporate mission, that's why, is to maximize the wealth of the shareholders. I see a couple of questions. So before I move on to the next slide, I'll just try and. Nagraj says, In terms of determining wealth, how would a company know how many shares to issue and at what initial price? That is completely different concept. We'll discuss separately about that, Nagraj. Otherwise, we'll be deviating too much. But I'll make a note of it and I'll give you some extra material so you can go through. And Santosh says to increase my capital at revenue. It's not clear anyway. I will not invest the amount, but I will start satisfying the customers with my product. Then the number of shares will increase if my product had good demand. I didn't understand it that well. Let me read it again. Your question is not very clear, Santosh. Could you please rephrase it? Again, Devendra Gupta, we discussed about stakeholders are people who have any say in the affairs, right? Shareholders are the part owners, people who invested. Stakeholders are people who have a say, who are affected by the decisions. Not necessarily they would have invested in terms of money, right? Right. Yeah, Santosh says to increase capital or revenue, I will not invest the amount, but I will start satisfying customers with the product. Then the number of shares will increase. The number of shares will not increase just because you're satisfying the customers, Santosh. If your requirement is 100 rupees, then that is, and based on how much should be the price of the share, that will be discussed later. But based on that, let's say 10 rupees is the right price for the share, then 10 shares will be issued. Just because we are satisfying the customers does not mean the 10 shares will become 20. No. That is not how it works. It depends on how much money you want to raise. Right? If the company is performing well, there is good demand for the product, Santosh, then the price of the share from 10 rupees it will increase. Right? The price of the share will increase, but number of shares will not increase, if that is clear. Next, we'll also discuss about the term corporate governance. Now, what is corporate governance? Corporate governance is a system of principles, policies, and procedures. This is something you have to remember what it is, because we hear about these things a lot. When we read about any article in the newspaper, any economic article, then you see corporate governance of a company. You read, right? So these are the terms that you should be aware of. So we just touch basing on them. So is the system of principles, policies, and procedures and clearly defined responsibilities and accountabilities used by the stakeholders to overcome the conflicts of interest inherent in the corporate form. These are the principles, policies, procedures which define the responsibilities and accountabilities. So you can overcome the conflicts of interest which are there in the corporate world. So this is the term that we call corporate governance. Some more questions. Balaji says, in companies having ESOP, employee share options, the employees also become its shareholders. True, that is correct. So sometimes as part of the bonus, companies issue share options. So some of the shares will be issued to the employees. So, but again, they are not creating any new shares. Please remember that no new shares are created from whatever is the holding of the company. From that, they give to the employees. right? If I'm saying I have to raise 100 rupees, I may not raise all 100 rupees by going for or issuing shares. I may already have 50 rupees with me. Only extra 50 I'll raise through shares, right? So if I'm issuing shares to the employees, I might give from the 50 that I have. If that makes sense, right? And again, Bharat Bhushan is also asking how it is decided, how many number of shares and all that. We will discuss that in detail separately, but not as part of our core, because that is not part. I'll just supply some extra material so you can go through. And if you all want to discuss, we'll discuss once. We'll just set aside a few minutes and discuss. Right? But it is not part of, it's not in the scope of what we are discussing. So I don't want to divert. Because as equity shares will only attract investors who can take risk. That's right risk. But when we go to shares, valuation of shares, and when we go to the risk and return, then we will discuss more in depth. Otherwise, if I say anything that if you are not aware of the terms, then it might confuse some of you. But all these questions that you are asking are very valid. Please do keep asking. When appropriate, we will discuss. Some of it we will discuss right away if it is relating to what we are discussing now. Right? Anything extra and not in the scope, I'm making a note and I will supply extra material. You go through and you can also take it offline. You can email me if you have any questions and I'll email back explaining. Right? Something not pertaining to the scope, we may not discuss it in the class. But that said, I'll still try and help you in clarifying your doubts. Okay, since the conflicts are dependent on the organization form, we will first take a quick look at the different forms of business organization. Right? Next couple of slides, we will discuss about what are the different forms of different business organization. Then corporate governance affects the operational risk and hence sustainability of the corporation. Right? Why corporate governance is important? Because it affects the operational risk and the sustainability. If there are inherent conflicts, what happens? The company cannot survive, right? Also, the company's corporate governance function affects the risk and the value of the corporation. We heard about Tata's recently, right? What happened? There was some conflict. If there is a conflict like that, the share price falls. So it's not good for the company. That's why corporate governance is very important. So we are again, as I said, we're not going into depth, but we'll understand the terms, we'll understand what it means. So if there is any, corporate governance is a system of principles, policies and procedures that define the responsibilities and accountabilities to overcome conflicts. If the corporate governance is not good, then it will affect the risk of a company. It will also affect the value of the company, right? It increases the risk and it affects the value. The share price will fall. If the share price falls, you'll see that the market cap also falls because it is share price times the number of shares. That's why strong and effective corporate governance is essential for efficient functioning of markets. If the companies are doing well, the market does well. Right? Santosh's Satyam is also an example, but Satyam has other issues. It's not just governance issue. It's not managing issue. Right? It has got other issues as well. It's a very complicated issue there. But here we are talking about corporate governance, which is basically the understanding the responsibilities and accountabilities. So the conflicts will be reduced or removed. Stakeholders are not, please understand, some of you are getting confused with the two terms, stakeholders and shareholders. Shareholders are the part owners of the company. Shareholders are the people who invest in the company. If as a company we need to raise some money, we approach people who invest, right? So if they are buying the shares of a company to invest, then they are called shareholders. And stakeholders are the people who are involved in the company matters. And they are not necessarily investing. They are people like you and me who are working for the company, could be, or the managers, or the CEO, right? or anybody as a team member, if you're working in that company, you're affected by the decisions of the company, you're involved in the running of the company in some way or the other, you're a stakeholder. Right? Please don't get confused with these two terms. And Param says, does the responsibilities and accountabilities being used by stakeholders include code of conduct or code of conduct only for employees? See, this is basically code of conduct is something like a principle, right? As a policy. So a company also has got a certain policies like that, not just for employees, right? The company has policies and all the stakeholders have to follow these policies. And the responsibilities are assigned. You are responsible for a certain thing. So that is your accountability. So what we are saying is this term corporate governance means it's a system of principles, policies and procedures. The things that we should do and should not do. By clearly defining the responsibilities and accountabilities by stakeholders, who is responsible for what. Right? So the conflicts can be minimized. This term vendors is used carefully. So we say stakeholders when it is appropriate. So when we are talking about procurement decision, when we are trying to get something, buy something or whatever, then stakeholders can be vendors, right? People from whom we are buying. But in generally speaking, when we are talking about corporate governance, we are not taking all those things into account. We are just talking about people who are responsible. Balaji is asking if corporate governance is measurable. That's a good question, Balaji. There are certain rules that we all have to follow, but I'm not sure how measurable that is. But I'll also explore. You also explore, and if you find something, let me know. That's a good question, though. I'll just make a note of it. So anytime, so we're all learning here together. So you know something, share with me. I know something, I'll share with you. All right. So can we move on? So I just wanted you to get an introduction of what corporate governance is, just to know what corporate governance is. That's a good question, Nagar. Who puts in place the corporate governance policies or procedures? So we are going to talk about it in a couple of slides. Just bear with me for a few more slides and we'll talk about it. So now, when we said organizations, what types of business organizations are there? Generally, when we talk about business, we talk about sole proprietorship, we talk about partnerships, we talk about corporations, and we talk about a combination of these, right? So these are basically the organization forms. And when we say ownership or sole proprietorship, then this basically I'll just increase the size so you can all see. So when we talk about sole proprietorship, the number of owners will be 1, right? Are owners liable for the firm's debts? If the firm has got any debts, any loans, are the owners responsible? Yes, they are responsible. Do owners manage fund? If it is sole proprietorship, the owners only manage the firm, right? Does an ownership change dissolve the firm? Because it's my own firm. If I'm selling it, obviously it will dissolve it, right? Whoever takes it, they become the owner. Access to capital is limited, and taxation is personal taxes. Again, we will not go into depth of all of this, but just to understand what it is. And when we talk about partnership, number of owners is unlimited. You can have 2 partners, you can have 10 partners, right? Are owners liable for the firm's debts? Yes. Each partner has unlimited liability, right? So, liability to debts. If they borrow money, are they liable? Each partner has unlimited liability, right? When we'll talk about this unlimited liability in detail in just a minute. Do owners manage the firm? Yes. Does an ownership change dissolve the firm? Yes. Again, this is more like a proprietorship, but instead of one person managing the show, there are people who are sharing. Access to capital is limited, and the taxation is personal taxes. Ashwini is asking access to capital. Access to capital here meaning the capital that is there with the firm. So can you access that capital, that money that is there, can you access that? When you're saying limited or, so we'll come down. See, when we're saying there is easy access to the capital, there is limited access to the capital, meaning you are the one who are investing, right? So you will have, if you are the one who are investing, then you will have the limitation of you have already invested. So where will you have the access? So we say limited access, right? And when it's a corporation, we say very easy access. There is easy access to capital, right? Also, the capital, if you want to liquidate it, if you want to sell it, right? If you want to sell it also, that is one more issue that you take it up. We'll just go through in detail about it in few minutes, but just give me a few minutes. Let me finish this slide and we'll come back to it. Now, I was also talking about the limited liability and unlimited liability. So just give me a minute, we'll come back to it. So yeah, so we were talking about the partnership, number of owners are unlimited and each partner has unlimited liability. Unlimited liability meaning the debt that you raise if something goes wrong, right? So let's say we borrowed 100 rupees, right? And if the company, the firm is not functioning well, or if it's a shop or whatever that is, you want to sell it off, or if something happens, you have to pay back to the, if you have to, all the loans that you have taken, you have to pay them back. If you are unable to pay them back by selling off the shop, if you have a shop, let's say, if you sell off the shop and you're still not able to raise that 100 rupees that you have to pay, right? You have taken a loan of 100, you sold off the shop, still you are not able to pay, right? So if you have a house that is of your own, that is not related to the shop, that can also be taken to pay the loan. That we call it as unlimited liability. If you are separating these two things, this is the shop and anything that happens to the shop is only pertaining to the shop. My personal assets are not taken into account. When you say that, that is limited liability. When you say unlimited liability, you have a shop, you took 100 rupees loan, you are unable to pay, your personal assets also will be used to pay off the debt. That is unlimited liability. Usually that's what happens, right? In this kind of a setup, in sole proprietorship and in partnership. Unlimited liability. Limited partnership with general partners and limited partners is kind of a hybrid. You can have this general partners and you can also have limited partners. So at least one general partner, but no limit on limited partners, right? So these are the various combinations. These are the various combinations of the organization. So we're just trying and understanding what the properties are. So GPs, when we say general partners, there will be unlimited liability. Limited partners, they will have limited liability. Meaning some people want limited liability. I just want to invest, but I don't want any of my personal assets to be attached to it. Right? That is limited partnership. So you can have a combination, is what it says here. So do owners manage the firm? General partners manage the firm. Limited partners do not. No role in management. They just invest. And Santosh asks, managing the firm is related to decision making. Decisions are involved in managing. I'd like to put it that way. A lot of decisions are involved in managing. And Vikas says, does partnership have legal entity? If you register, you will have. Alright, so does ownership change, dissolve the firm? We're talking about the general partners and limited partners. General partners, yes. Limited partners, no, cannot change. Limited partners, anyway, they are not involved in the managing of the firm. right? So if they come, they go, it doesn't matter. But the general partners who are actually managing the firm, if there is a change in ownership there, the firm will dissolve. Again, access to capital is limited. The limited liability company. Now here, number of owners is unlimited. Are owners liable for the firm's debt? No. Here, owners are not liable for the firm's debt. This is limited company. Limited company, lot of people are investing. So here, there is no liability. And owners manage the firm? Yes, they manage the firm. Ownership change, will it dissolve? No, it will not dissolve. Because there are a group of people coming forward, one person manages. Right? Again, access to capital is dependent on the size. Who invested what will have access to capital based on that. And when it comes to corporations, again, number of owners is unlimited. Sorry. And are owners liable? They are not liable for the firm's debt. Right? Because when you say limited company or corporation, it is an entity by itself. It's an entity by itself, so no one person is accountable. So as a firm, as an entity, it is liable. Right? And ownership, although managers generally have an ownership stake, still, if the company owners manage the company, usually they do not, although they have the stake in the company, they usually do not manage. And does ownership change dissolve the company? No. Right? And access to capital is very easy. And taxation is double taxation. Earnings taxed at corporate level, dividends taxed at personal level. Right? If you get earnings, if the company is able to generate earnings, that is taxed on the company rate. And if you are getting personal, because you also have invested in the company, as an investor, you will be getting dividends. Those dividends will be taxed at personal level. Right? I see a lot of questions here. I'll quickly go through some of it before we break. Param says corporate governance may be measured on a scale of depth and width of governance. With governance environment refers to awareness among stakeholders about the corporate policies procedures. Depth of governance reflects the level of non-compliance to these policies and procedures, which could be known for corporate audit in general. Param seems to have a bit of background in that, so he's giving us some information here. And Girish Kumar is asking a question. Limited partners can, no, he's just saying limited partners can be called as sleeping partners. Yeah, that sounds right, Giri. Access is limited to GP also. Meaning? I didn't understand that question. The next one is row number 1, sole proprietor. Individual has complete access to capital as it is their own company. Then Y table shows very limited access to the capital. In LCC, is there any single who is called owner? Some of your questions are not very clear. Incorporated in American company names denote what? With reference to this slide, madam. Balaji is saying incorporated. It's a corporation. It's registered entity. What is joint stock company? Joint stock company. What is joint stock company? I'm not sure what you mean by that. Are you talking about partnership? Can you give an example maybe of limited partnership? Limited partnership. So generally when you're talking about partnership, here when you say limited partnership, you're saying that at least one with general partners and limited partners, right? Limited partnership meaning you're investing in the company, but you're not involved in the functioning, you're not involved in the management, right? That is limited. right? So if limited partnership meaning there is one person who is running the company and you have invested, and somebody B and C have invested in the company, but they are not having any role in the management, right? That is limited partnership. We are in the, just like the sleeping partner somebody has pointed out. We have invested in the company, but we have no role in the company. If the company performs well, we'll get some profit. If the company does not perform well, we lose our money, but nobody will attach our personal assets. Nobody will take our personal assets, right? That is what it is. In terms of access to finance, can a corporate present its market cap as an asset to secure loans from bank? That's a good question. The value of the firm, basically more market cap is basically the, just like, you know, if you have a, I'll just give you an example. If you have a, let's say a property, and the value of the property is, let's say 20 lakhs. Right, of which you have paid out 10 lakhs and 10 lakhs is outstanding. So if you want to secure a loan, you can pledge, not really pledge, but you can show this 10 lakhs, that is the value of the property for which you are the owner, and secure a loan. Right? So that way you can do. So if you can do it that way, so you should, in theory, you should be able to do for an organization, but it may involve more complexity because there is not just one owner. As an entity, a decision will be made to secure loans. I'm not completely aware of that part, but I can explore and get back to you. I'll just make a note so I can explore and get back to you. Owner refers to the term whoever has invested. Limited ownership meaning people who have invested but not managing, but still invested. So basically when we are talking about sole proprietorship and when you're saying number of owners, basically are we talking about the people who have invested, right? So these are some of the things that I just wanted you to understand. This is not the core finance, corporate finance that we would be discussing, so I may not, probably wouldn't have given answers to some of the questions, but then I've noted them and we'll come back to it. So we'll discuss about agency problem. Again, we'll briefly discuss what this is. I'll just quickly break it, take a 2 minutes break, and we'll come back and discuss.